Earlier this week, the Nasdaq Composite reached a new all-time high, completing the V bottom and recovery. With the completion of the V, what do past performances indicate for how well we will perform in the future? If Thursday was any indication, we better take a closer look. Looking at this chart of the Nasdaq, you can get a quick idea of why it's called a V bottom and recovery. But will this help give us an idea of future performance? Let's take a closer look at the Nasdaq Composite. Looking back on data for the Nasdaq Composite to 1971, we can look at each time the index first reached an all-time high, then fell by at least 10%, followed by a new all-time high within the year. Interestingly, it happened 15 other times, and this table shows the summarized returns following these 15 time periods. As you can see from the average return and the median returns, that in the upper table, the V recovery pattern has been a bullish signal. Looking at the column for the 6-month return, after a V recovery, the index averaged a gain of over 16% with positive returns each time. And as the lower table shows, the typical 6-month return for the index is around 6%. What is particularly interesting is that every time frame shows a higher average return than what is typical for the index. This table here lists the 15 times the Nasdaq has had a V bottom. Looking at the table, you may notice that most of the occurrences resulted from the 1990s tech boom. So, what would the returns look like if we removed the 1990s results? And then this table here shows the performance of the Nasdaq after V bottoms, but without the data from the 1990s. As you may expect, the returns are still bullish. And once again, the average returns beat the usual index returns at each time frame examined. The S&P 500 and the Dow Industrial still have more time to go before they signal a V bottom and recovery. But looking at the data for the S&P 500, that index did not consistently lead to outperformance. The average return and percent positive underperformed the typical S&P 500 returns at the 2-week, 1 and 3-month timeframes. However, the returns were slightly better from the 6-month period and beyond. So, what could go wrong for the markets? Well, this could go wrong. Now, I've talked about the VIX, and we've been watching it for a number of weeks now. My timing isn't perfect, but I put you on notice several weeks ago that sooner or later the VIX was going to explode again, and now it did on Thursday. So we got to keep a close eye on the VIX here. As you can see, it was hovering around that 24 level, but then blasted off and hit 40.79 at the close on Thursday. So it may continue on here, and I don't think it's going to be over for a while. So keep your eyes on the VIX and hold on to your cash. There may be some opportunities coming up here in the near future. At least I'm eyeing some for myself. And for today, that's ChewDog Charts. Thank you.